Hi, my name is Bhavini Kalaria and today I'll be sharing 6 totally legal tax tips for non-dom UK residents. Keep watching to find out more. If you're a UK resident whose permanent domicile is outside the UK, you may be considered a non-dom resident and you may be able to enjoy certain tax benefits as a result. Here are 6 completely legal tax tips for non-dom UK residents to help you make the most of your status. Number 1. Use foreign bank accounts. If you're working permanently in another country, opening and using bank accounts in the country in which you are domiciled means you won't have to pay UK foreign income or capital gains tax on your earnings. However, if you transfer your income to your UK bank account, it will be taxable. Number 2. Claim remittance. If you still wish to transfer your foreign income into a UK account, you can claim the remittance basis. This means you'll only pay tax on money you bring into the UK. However, claiming remittance can be complex and result in the loss of certain tax-free allowances or a high annual charge, so a solicitor should be consulted if you are considering this option. Number 3. Claim tax refunds. If you're being taxed by the UK and by the country where you're earning foreign income, you can usually claim tax relief to have some or all of your tax refunded. This can typically be done by claiming foreign tax credit relief when filing your annual tax return and reporting your foreign income. The amount you'll get back is calculated according to varying factors, so you may not be able to claim back the full amount you paid. Number 4. Get foreign workers exemption. If you work in the UK and abroad, you may qualify for foreign workers exemption if you meet certain criteria, such as earning below £10,000 at your overseas job, or if all of your foreign income has been subject to foreign tax. A qualified solicitor should be contacted to help review your circumstances and determine whether you meet the necessary requirements to apply. Number 5. Lower inheritance tax on UK and overseas properties. Contrary to popular misconceptions, overseas properties held by non-dom UK residents are still subject to UK inheritance tax. Placing both your UK-based and foreign assets in a trust for at least 7 years prior to your death could mean the assets will no longer be considered part of your estate and therefore will not be subject to hefty IHT. It's important to remember that some countries may still deem assets held in a trust as part of your estate, so be sure to consult with a local solicitor in the country where you're domiciled to verify whether your assets will still be subject to local inheritance tax. And finally, number 6, getting principal private residence relief. Under new legislation set to come into force in April 2015, non-dom UK residents will only qualify for principal private residence relief on sales of their UK property if they spend a minimum of 90 days in that property per year. The time can be split between spouses, making it more feasible for couples. If this criteria is not met, then you will have to pay CGT on the sale of your UK property. The subject of domicile and its related tax considerations is a complex one that requires an in-depth understanding of the relevant laws and regulations, particularly if you hope to adopt effective tax reduction strategies. Contact us at the London Law Practice to see how our team of specialist solicitors can help.